On Money Talks today, technical analysis of trends, charting a course to better returns in the markets. Welcome. Thanks for joining us on Money Talks today, ABN's personal finance program. I'm Martin Sung, reporting in Singapore. Well, to some, technical analysts are the ultimate market savants, devoted students of the market who spend years mastering the craft of charting the market's course with rigorous mathematical models. Others view the craft as voodoo and its proponents as charlatans whose manic fixation on prices ignores the subjective nature of market activity. But experts say the greatest value of technical analysis may be that it adds a valuable dimension to market trading that is often overlooked by many investors. Here's more.
A technical analyst might be described as a market clairvoyant who divines the future from the past. Although there are dozens of different methods of technical analysis, most analysts rely on one tenet: history repeats itself. Techies pore over charts and graphics of entire markets and individual stocks, looking for recurring patterns. To the purist, any consideration of the company's earnings, the state of the economy, or other underlying fundamentals is regarded as heresy. All pure technicians care about is the price data. They believe all the knowledge available in the marketplace is already factored into prices. To be sure, there is some measure of fanaticism in it all. Many in the purist camp presume that there is some metaphysical inevitability to price movements. The catch is finding the right mathematical connection or cycle to chart these price moves. Still, the use of charts isn't confined to some fringe group of market mystics. Many floor traders, speculators, and even some long-term investors dabble in this esoteric art. Of course, even the most devoted chart follower admits there are limits to technical analysis. Smaller emerging markets, such as Malaysia, rarely lend themselves to technical forecasting. That's because one large trade makes them swing wildly. Others note that some derivative products are so new, there isn't enough data to accurately track them. While most chart watchers don't claim to be infallible, they argue that spotting the trends first is the way to profit.
Well, we're joined now in our Singapore studios by Ivan Krastins, author of Listen to the Market, and he is a private trader and also a professional educator. Ivan, good day, welcome, and thanks for joining us.
Thank you very much.
First of all, how pure a technical analyst or chartist are you? Do you ignore or not look at fundamentals at all?
110% I follow the charts.
Why?
The charts to me represent everyone's input into the market. So I'm looking to see which way the majority of people are dealing with the market, and I look to do the opposite to what the majority of people are doing.
Right, okay. Charting though, how much of this really is self-fulfilling prophecy? If enough people can be gotten to believe it, including investors, they act on it, it happens.
It's fantastic. It'll work even better. Until it reaches the stage where it self-destructs.
Right, okay.
If everyone believes it's going up, he'll be the one who sells to allow the price to go up. So initially, it's going to work very, very well.
Right, so it seems to make sense. Now, as far as you're concerned, what exactly do you use charts for? Trading only for yourself? Or?
Only for myself. I don't advise clients. I just trade for myself, the US futures markets, US options markets, and occasionally the stock markets as well.
Right, okay. All right, let's go ahead. We have a series of charts here. Let's call those up, look at the first one, and tell us more about that, Ivan.
Okay, well, the basic element looking at the chart is that the history repeats itself and markets move in trends. So what we're seeing here is the Japanese stock market, where we have a very clearly defined trend going to the top of 1989, being the top of the market, and then a reversal of trend. Trends can exist both with upward bias and also a downward bias. On the next chart, when we're looking at the rice futures itself, there we can see some lovely trends in the commodity market. So trends are not only confined to the stock market, but any market at all. You can also see a little bit of the cycles underlying that particular commodity market, being the rice futures market itself. The second basic element of technical analysis of history repeating itself, if we have a look at the Dow Jones chart now, we'll see that the Dow Jones back in 1929 made its initial top, then had a fall, marked by point number 2. The market from point number 2 staged what's known as a secondary rally or a retest of a high. Now once a market retests a high, it's a very bearish scenario implying lower lows to come, which in fact do come at point number 4. Moving along now, looking at the Nikkei Japanese stock market, there we see the top at number 1. Number 2, we have the first break, breaking a previous low. Number 3 again is a secondary top, the retest of the high, predicting, if you will, forecasting or promising lower lows to come, which come at number 4. The interesting thing to look at is 1929 for the Dow Jones, 1989 for the Nikkei. History repeating itself.
Okay, on different markets, though.
Yeah. different markets, but it's a human nature involved with the stock market.
Okay.
On the next chart, you're looking at the US Treasury bonds. Most traders had a very rough time with the markets last year in 1994, but using the definition of a trend, when a market fails to make a higher high, as it did in October, November of 93, and starts to decline, that's saying look for lower prices. The markets then went sideways to the next arrow, failing to take out the previous high, and that screamed that we had a high probability short on our hands. Now what it didn't tell us was how far down the market would go. So from a personal trading point of view, I never looked to forecast the magnitude of the move.
Okay, now at that 94 February period, fails to make a new high there. After going, as it goes down, that of course is in reaction to the cycle of the string of interest rate hikes out by the Fed, no doubt.
No, to me, the markets fall because the sellers are more powerful than the buyers, and the markets rise because the buyers are more powerful than the sellers.
Okay.
The fundamentals I don't look at all. The next aspect of technical analysis, if we look at the news already being in the market, so if we look at the crude oil chart coming up now, we'll see that the bottom was made, in fact, on June the 20th. The fundamental of the invasion of Kuwait took place on August the 2nd. So the news was well and truly already factored into the marketplace. And that's why traditionally markets are most bullish at the top, hence participants are very bullish at the top, as they are with the American stock market right now, which is in a very dangerous spot, and they're most bearish at the lows of a market as well. So the news is always in the market itself.
Let me just jump in here. Do you ever use charts to look ahead or to trade ahead?
From an ego point of view, it would be nice, but very dangerous from a trading point of view. Most people use charts to justify their view, whereas I use charts to give me a view.
Right, so only up until the day of trading or up until execution? Up
until execution, which could be a monthly chart or a weekly chart or a daily chart or even an hourly chart.
Oh, interesting. Okay, now you trade on your own account.
Right.
Just from personal experience, I mean, how does that work for you? Does it involve a lot of overhead, a lot of infrastructure, or how do you do it?
I spend about 5 hours a week on the weekend looking at the US futures markets. I download daily from a database in the States straight into my PC, analyze the charts, look at what the markets could be doing, and then I wait for a trigger to actually do something.
Right, you work from home, or?
I work from wherever I have a telephone, and my mobile office is always with me.
That's all it takes?
Well, all it takes.
Okay, go ahead, Ivan. Let's have a look at some more charts now.
Okay, there are four basic types of charts that people use. A line chart just simply connects the closing prices from one period to the next. It's a very rudimentary chart. You can see pictures of clearly defined trends up, down, and also sideways patterns. This sort of chart is good to see the bigger picture in some ways. For more information, we look at a bar chart. The bar chart contains the opening price and the closing price and the highest and lowest prices for that period. So we're starting to see a bit more detail in a bar chart versus a line chart. The next chart, being a candlestick chart, these were used 300 years ago in Japan by rice traders. So it's very old technology, very efficient technology.
What do they tell you? This looks interesting.
You'll notice some of the bars are filled in this case they're yellow. That simply means that the close is below that period's opening. It's a very bearish scenario. If the body is not filled in, it's white, it means that the close is above the opening. In other words, open on the lows, close on the highs, it's seen to be bullish for the next period. So as each information comes in from one period to the next, you're seeing, is it confirming it or not?
Okay. Now, of the charts that we've looked at so far, which type do you prefer to look at?
Definitely candlesticks. There's a strong case to be made for using the line chart with some of the indicators we'll look at later on.
Right.
The other type of chart that we can use are point and figure charts. They have no element of time at all. You'll see a series of zeros and crosses. Crosses represent prices going up. In other words, the buyers are stronger than the sellers. Zeros represent the prices coming down, the sellers overpowering the buyers. They can very clearly see certain double top type formations when a price goes to a level once and then twice and it's repelled. Also double bottoms, triple bottoms. So the classic chart patterns can be seen on point and figure charts.
Okay.
They're very interesting from a currency trading perspective.
Why so?
A lot of people chart that minute by minute, trade by trade, so they can see the invisible support and resistance levels in markets that are not obvious on a bar chart or a line chart. On the next graphic, let's have a look at a bit of a walkthrough on the Nikkei to show you how one can apply this from a safety point of view and also from a profiting point of view. Remembering the definition of a trend is a market making higher highs being a trend up, lower lows a trend down.
Sure.
At point number one, the trend is not up. It's failed to go higher than the previous high. So at that point, someone using charts would say, let's get out of this market or let's go short in the market. The market fulfills that promise by coming down. The ranges start to expand. But when we come down to point number 3, you'll notice before the upward movement, the range in fact has been smaller than the previous one. The sellers are running out of steam, which is implying an upward bias, which we get on that very strong barn going up. After
Sellers
that,
running out of steam, so the market's bottoming then.
yeah.
Yeah.
In other words, the sellers are being overpowered by the buyers. The buying interest is coming back in. We have that sudden jump, and then the market goes sideways at point number 4. Now, the sideways pattern is a gift. It's like the quiet before the storm. The longer a market goes sideways, the more explosive the movement will be out of that sideways pattern.
Either up or down.
Yeah, either up or down. We don't know beforehand which one it will be, but probabilities give us an indication of which way it could be. For example, the market bottomed strongly, had a very fast rally, but it went sideways, saying, well, the buyers are really still in control, but of profit taking coming in. At point number 4, we get a very powerful reversal pattern on a chart known as a doji. It's where the opening price and the closing price are the same level. So the buyers and the sellers, it's a stalemate. A stalemate when the market's coming down is very bullish. From there, the market exploded up to point number 5.
Can we jump in here? Where's the, what was that term again? The doji?
Doji.
Doji. Where is that on the chart again?
Marked at point number 4.
Right.
The open and the close is at the same level. There's no real body there at all. Just a shadow at the bottom and a bit of a shadow at the top.
Ah, okay.
One really needs a very fine eye for detail to see these patterns in the markets and also to believe them. Most people with a chart will believe or see what they believe rather than believe what they see. That's a real challenge.
Okay.
At point number 5 again, the market starts to run out of steam. We get the gift coming along courtesy of the small ranges, and the same configuration at point 5 gives us a sell as gave us a buy at the very low. It's a technical pattern known as a key reversal, where the price trades higher and lower than the previous period but closes at the other period's extreme, in this case down, preempting the fall. The fall that we had down at point number 6 was rather textbook and magic at the end of 93. It was so textbook because it was in a very expanded range. In fact, the largest range for that entire fall, which is promising lower lows to come. So as soon as we saw that expanded range, at point number 7, we were looking for chart signals to sell that market. The fall then ensued, and just recently the Nikkei has broken the low of 0.6.
16,000, yeah.
And it looks like the ranges are becoming smaller.
Right.
If the market finishes the way it is now, it's a potential turning point.
All right, just out of curiosity now, I know you don't like to do this on a trading basis, but I'm sure you have had a look ahead on the Nikkei. Where's it going?
Anyone's guess. We're so close to a bottom technically, but we need the confirmation from a chart signal. The danger with using this knowledge is to forecast how far.
Right.
And the problem with working with risk to reward ratios, we're assuming a lot of things with risk to reward ratio, so I just do not like to forecast.
Okay.
The distance, but the direction, that's much easier.
Okay, what direction is that then?
It's looking for a buying opportunity.
Okay.
And with the Dow Jones, we're looking for a selling opportunity at the moment.
Okay.
So the markets are at very crucial levels.
All right, Ivan, thank you very much. We'll have to take a quick break right now. When we come back on Money Talks today, we'll continue our discussion on technical analysis and trends. Stay with us right after this.
You can read about Money Talks in every issue of Asia Magazine.
Just thinking about how long it had been since we last got away. Then I found I'd earned enough passages kilometers by using my Citibank preferred card to take Linda all the way to paradise for free.
Citibank preferred cards, the only credit cards that can take you where you prefer to be for free. Aboard Passengers, Asia's biggest frequent flyer program.
Once upon a time, you lived in a world where there were no right or wrong answers. The world of imagination. Today, the products of NEC help you remain in that world. Despite deadlines, dotted lines, and bottom lines. Imagine that.